Did you know that missing the right time to refinance could cost you tens of thousands of dollars? It's true. Refinancing can be a powerful tool for managing your finances, but timing and strategy are critical. Today, I'm going to show you how to recognize the perfect refinancing opportunity, what mistakes to avoid, and why waiting too long can leave you with limited options. So let's dive in. Welcome to my channel. My name is 𝐬𝐮𝐬𝐫𝐞, Mortgage Guy, and we're here to break down everything you need to know about mortgages, real estate, and building wealth. If you're new here, hit the subscribe button and turn on notifications. We've got weekly videos designed to empower you in your financial journey. Now, let's get started. Here's what we'll uncover today. Number one, we're going to understand how refinancing impacts your home's value. Number two, the role of current market conditions. Number three, real life case studies that highlight the do's and don'ts. Number four, timing your refinancing decision to avoid costly mistakes. But before we dive in, I'm 𝐬𝐮𝐬𝐫𝐞, a licensed loan officer with over 18 years of experience helping families navigate the mortgage landscape. I've seen benefits of smart refinancing decisions and the heartbreak when it's done wrong. So let's make sure you're on the winning side. First, let's define what refinancing is and how it ties into your home's value. Refinancing is the process of replacing your current mortgage with a new one, often to secure a better interest rate or access equity. Sounds great, right? But here's the catch. Every time you refinance, you're resetting the clock on your mortgage, and this can impact your equity and long-term financial decisions. What are the current market conditions? Interest rates and housing markets fluctuate, and these changes directly affect your refinancing decision. For instance, in high interest rate environments, refinancing could mean locking in a higher rate than you currently have. The second thing to consider is how refinancing affects your equity. Equity is the portion of your home's value that you truly own. Every refinance comes with closing costs and fees that chip away at that equity. Plus, taking cash out reduces your stake in the property. The third thing to consider is property appreciation trends. Your home's value are not static. So if you refinance during a peak market, you can lock in equity gains. However, if the market declines, you may find yourself underwater, owing more than the home is worth. So let's look at a case study real quick. Let's take this $400,000 home and see how refinancing looks at different times in the last 15 years. In 2010, the average interest rate was 4.69%, and your principal and interest would have been $2,073 for that $400,000 refinance. In 2015, the rates were right around 3.85, whereas your principal and interest at that time would have been $1,874. In 2019, the average rate was right around 3.94%, and your principal and interest would have been $1,896. In 2022, the rates elevated a little more to 5.25, and your average principal and interest would have been right around $2,208. 2024 just ended, so let's just say the hypothetical average rate was 6.5%. Your principal and interest at that time would be $2,528. There's a lot of variance in the monthly payment. Now, let's go ahead and factor in the average annual appreciation now. Using data from Zillow and Realtor.com, homes have appreciated at an average annual rate of approximately 4% a year. For an 80% loan to value on a $400,000 home, here's how the value trends would look through 2025. If you would have done that refinance in 2010 at $400,000, today with the 4% appreciation, your house would now be worth $560,000, whereas you paid that mortgage down some. In 2015, with the appreciation, today's home value would be $488,000. If you would have refinanced in 2019 for that $400,000, you'd be at $464,000. And in 2022, the refinance at $400,000 would now put you roughly at $448,000. Now that we understand the basics, let's talk about the timing. Knowing when to refinance is crucial to protecting your home's value. The things that are really important are interest rate triggers. When predicting interest rates, it's nearly impossible. You can watch for patterns. A general rule of thumb is to refinance when you can lower your rate by at least 1%. But remember, rates are influenced by broader market conditions and your credit profile. The second thing to consider is equity threshold. Equity is your safety net. Before refinancing, ask yourself, how much equity do I have? How much do I want to take out, or am I going to take out? Let's say you're considering using equity to pay down high interest credit cards or consolidate auto loans. Run the numbers. Will the new loan save you money in the long term, or are you just shifting debts? Next thing to consider is life event timing. Major life events like a job change, marriage, or sending your kids off to college can often influence your decision. For example, refinancing for a home renovation might make sense before a major life event increases your expenses. Next thing to consider is market condition indicators. This is really important. We always look at the trends like property appreciation and buyer demand. These give clues about whether it's a good time to refinance or not. Here are the reasons why people refinance. The first thing is people refinance to lower the rate only. Let's just say you have a $300,000 mortgage at 5%. Refinancing at 4% saves you $200 a month, but costs $5,000 in fees. It takes 25 months to even break even. So if you refinance or sell your house before the 25 months, you're losing money. Refinancing for cash out, and let's just say in this instance, $50,000 cash out. You use the funds for home improvements that add value to your home, like a new kitchen or a new bath. However, keep in mind, this increases your loan amount. Refinancing to pay off credit card debt. Say you're consolidating $30,000 of credit card debt with a 7% mortgage rate. While you lower your overall interest cost, your mortgage payment increases by $180 a month. Is it worth it? It may be if you're eliminating $1,200 a month in payments on credit cards, as that is a monthly savings of $1,020 a month. However, you do stretch your mortgage out to a longer 30-year term. Finally, let's discuss the pitfalls of refinancing. Avoiding these mistakes to ensure that you don't hurt your home's value is really important. Refinancing too often. Each refinance comes with cost. Doing it too frequently erodes your equity, not accounting for market cycles. If you refinance during a peak market and your home values drop, you risk negative equity when you go to sell or refinance. Ignoring that long-term cost is a really costly mistake because short-term savings can come at the expense of long-term wealth. You always have to evaluate the big picture. And finally, let's talk about rolling in unnecessary debts. Consolidating those low interest rate student loans or lower interest rate auto loan into a higher mortgage isn't always smart. Always do the math with your loan officer. Let's go over some of the products and refinancing options that are available to almost every consumer out there. Refinancing is definitely not a one-size-fits-all solution. Different loan products offer unique advantages and potential drawbacks depending on your financial situation. The first loan we want to talk about is a conventional loan. These are really the most common loan types, and refinancing with a conventional loan often provides a better rate with borrowers with strong credit. Options include rate term refinancing to lower your interest rate, or a cash out refinance to access your home's equity for other needs. Conventional loans typically require private mortgage insurance or PMI if the loan exceeds 80% of the home's value, and that's basically insurance to kind of cover the lender just in case you have a default. The second most popular refinance option is going to be an FHA loan. Now, this loan is backed by Federal Housing Administration, so it's a government loan, and FHA loans are designed for borrowers with lower credit scores or smaller down payments when they purchase the home. Refinancing options with the FHA include streamlined refinance, which is a simplified process by requiring way less documentation and no appraisal in most cases. If you're looking to get cash out, the FHA refinance is a really good option because it does allow you to pull out up to 80% of the home's value for cash out purchases. However, FHA loans include an upfront mortgage insurance premium, which is different from PMI, and it's MIP, and it's ongoing monthly premiums over the life of the loan. The third type of refinance that we want to talk about is a VA loan. This is for all eligible veterans, active duty service members, and certain surviving military spouses. VA loans offer a very unique benefit. The VA loan has two types of refinances. One is the VA interest rate reduction loan, which is the IRRRL, also called a streamlined refinance, which just helps you lower the interest rate. VA also allows you to cash out refinance for most borrowers to tap into their equity up to 100% of the home's value. Keep in mind, if you are going to tap into the full 100% value of your home, please make sure that you have a long-term plan to stay in the house and you're very confident that the value will increase in the home in the future. The fourth type of loan that we want to talk about refinancing is a USDA loan. These are designed for rural and suburban homeowners. USDA loans offer low interest rate financing for low to moderate income borrowers. The USDA streamlined line refinance option makes it easier to reduce your rate and payment, though these loans require the property to remain in an eligible rural area. If you're refinancing for cash out, you have to look at either an FHA or a conventional loan for cash out when refinancing your current USDA loan. The next type of loan that we want to talk about is a jumbo loan. Jumbo loans are for high value homes exceeding the conventional loan limits. Jumbo loans are available for refinancing, and refinancing a jumbo loan often comes with a higher interest rate and way stricter requirements due to the larger loan amounts involved. Adjustable rates are a really good loan to refinance because borrowers with adjustable rate mortgages or ARMs may refinance into a fixed rate to lock in a predictable payment or reset that ARM term. When people had those adjustable rate mortgages and rates were dropping, they were really happy, right? Because the rates kept on going down. However, in a rising rate environment, if you are in an adjustable rate mortgage and you're uncertain of how the market's going to go, it's a great idea to refinance those adjustable rate mortgages. While ARMs often start with lower rates, the periodic adjustment can result in significantly higher payments if the rates rise. The next type of loan that I want to talk about is a home equity line of credit or a HELOC. Now, let's just say you bought your home in 2020 and you got a rock star interest rate of 3%, 2.5%, or maybe even 3.5% or 4%, right? Those rates are not around anymore. Because of everything that happened from 2020 to 2023, 2024, values have increased a lot. A home equity line of credit is a great stopgap for borrowers that want to keep their current interest rate. However, they need that extra equity to maybe pay off some revolving credit or pay off some medical bills or even send your kid off to college. A home equity line acts as a revolving line of credit secured by your home's equity. Think of it like a credit card on your home. Because your home is secured with this home equity line, you're going to get a lower interest rate. However, because it's in a second lien position, you're going to get a higher interest rate than your standard conforming conventional VA or FHA loans. Refinancing with a HELOC or a home equity line of credit can be a good option for homeowners seeking flexibility, but it's essential to understand that HELOC rates are often variable and can increase over time. By carefully considering these loan products, you can select the refinancing option that best aligns with your financial goals and current circumstances. Each product has distinct qualifications, benefits, and costs. It's crucial to work with an experienced loan officer to navigate your choices effectively. Refinancing is a dynamic process influenced by several factors. Understanding those key points can help you avoid surprises. These bonus surprises are going to be rate lock expiration. When you apply for a refinance, your interest rate is often locked for a set period, typically 30 to 60 days. If the rate lock expires before your loan closes, you might face higher rates. And if the market has shifted, you have to be proactive with your loan officer so that you don't get a higher rate. By providing the documentation and communicating with your lender, it will avoid delays and extra cost to you as the homeowner. Property value fluctuation is a really big thing. Home values can change between the time that you refinance application is put in to the closing date. A lower than expected appraisal might reduce the amount that you can borrow or increase the loan to value, impacting your rate and your terms. Be certain to be there when the appraiser walks into the house, talk to them, ask them if the value is close to what you are seeking. Talk to your loan officer once the appraisal comes in, and if it does happen to come in low, there's a clause called the Tidewater clause where you can actually send in additional comparables for the appraiser to reconsider the value. Another thing to really look out for is credit score changes. Your credit score is critical for securing favorable refinancing terms. Avoid opening any new credit accounts, making any late payments, or taking on any significant debt during the refinance process, as these can negatively affect your score. Debt to income timing is really important as well. Lenders evaluate your debt to income ratio during the refinance approval process. Large purchases or debt can increase your debt to income ratio and jeopardize the loan approval. Always hold off on major financial changes until closing. It's also really important to look at all of your debts with your lender. If you have, let's say, 2 credit cards, both of them have $10,000 balances. However, one of them has $100 a month minimum due at like 17%, and the other one has a $500 a month due, and let's just say it's 10%, you have a promotional balance. You may want to weigh everything out. Is it worth paying off one of the credit cards to have that higher payment taken off, or is it more beneficial to you to pay off the other $10,000 that may have a higher interest rate but a lower monthly obligation, or is it better to just pay both of them off? The employment verification window is also very important. Lenders verify your employment and income multiple times during the refinance process. Changes in your job status, hours worked, or income level can complicate or derail your approval. Communicate any changes to your lender immediately to address potential issues, and work the hours that you've always worked on the pay stubs that you provided to your loan officer. Refinancing your home is a significant decision, and I'm here to help you navigate with confidence. Here's how to get started. I'm David �11, mortgage guy. I work with the world's largest wholesale mortgage broker. When it comes to product, pricing, and speed, it's really important to go wholesale. Wholesale versus retail, based on 2021 HMDA data, shows that you will save between $8,000 and $11,000 over the life of the loan when going wholesale versus retail. What's really important is, if you want to work with us, schedule a free consultation so we can discuss your unique financing goals and explore your refinancing options together. Second thing is, find out what rates you qualify for and compare the scenarios that are tailored to your needs. Download a document checklist to streamline your refinance process, and download our comprehensive checklist of required documents that cover all of your income, assets, and liabilities. Contact me directly. Click on the link that has all of my contact information and set up a time to talk to me and my team in the video description below. Take the next step towards smarter financial future. I look forward to helping you. I'm David �11, mortgage guy, and I'm out.